Back in May, they expected the government's deficit this financial year would be 0.8%, the size of the economy. Now they're predicting 2.3%. So, there's a blowout in the government's deficit underway. Hello again, everybody, and welcome to my weekly look at any new developments in New Zealand's housing market and with regard to interest rates. On the interest rate front, we haven't seen too much new over the past week. The wholesale interest rates haven't moved all that much. We have seen a couple of banks lift their fixed lending rates just a little bit more, and that comes about pretty much for the same reason as other increases in interest rates over the past 3 to 4 months. Nothing to do with the New Zealand domestic economy. It's because of increases in worries about inflation, mainly for next year in 2025 in the United States, leading to reduced expectations of monetary policy easing over there next year, which has just led to some increase in the medium to long-term fixed interest rates over in the US markets, which has fed through to the situation here in New Zealand. Now, one of the factors also pushing up the US wholesale interest rates has been concerns about an increased volume of debt being issued by the US Treasury, and there has been that similar factor in play here in New Zealand as well. The government's accounts are deteriorating significantly because businesses are having their profits squeezed by costs going up, but not being able to pass on those cost increases into selling prices as much as they would like to do. So tax payments to the government going down, and a warning I've been giving in talks over the past few months has been that whatever party comes to power on October 14, there's going to be a tightening of fiscal policy, a bit of a reining in spending, because unfortunately we've got, again, a bit of a deterioration in New Zealand's fiscal accounts. The Finance Minister has already reacted to this by looking at shaving some spending off and finding some efficiencies, which I guess could have been found 5 or 6 years ago as well. But whatever, I think the government felt inclined to act, given that 1 or 2 weeks ago, the Reserve Bank released their predictions for the economy, inflation, etc., including the government's accounts, and they predicted a deterioration in the government accounts. Back in May, they expected the government's deficit this financial year would be 0.8%, the size of the economy. Now they're predicting 2.3%. So, there's a blowout in the government's deficit underway, and that does mean if you think you've got some inside word on timing for either tax cuts next year or the year after, or spending increases, I'd pull back your optimism just a bit, because this is something the government's going to have to be looking at addressing after October 14. So a little bit of upward pressure on interest rates from that source as well. On the housing market side, I'm just running my monthly survey of real estate agents at the moment, and personally I'm not very surprised that basically all of the measures I look at that I ask agents to give insight into are showing increased activity in the markets. I've got a further increase in FOMO, the fear of missing out. I've got a further decrease in FOOP, fear of overpaying. Not as many people now are worried about buying and having prices fall, as has been the case for a great period of time. Many more first home buyers in the market. They can see that things are moving. They know what this is going to mean in terms eventually of prices, and certainly in terms of the availability of properties. I've also got, partway through the survey, about a net 6% of agents saying they're starting to see more investors in the market. Now, this is sort of the big uncertain factor out there. If we get a change in government on October 14, we can anticipate that the tax deduction rules will go back to what they were before March 27 of 2021. Some more investors will come into the market. How many will come in, what impact they will have, I find it pretty impossible to gauge that, given that interest rates are at pretty high levels and the numbers simply don't add up for people looking at maybe increasing their exposure on the residential property side. And we also just have to take into account that, as I mentioned last week, there is a deterioration in China's outlook underway. This is going to be relevant in terms of depressing incomes for the primary sector in New Zealand, farmers, horticulturalists, people in the forestry, fishing sector, etc. Really, I guess to me, it just reinforces the view I've expressed for a long time here, that when the housing market upturn comes along, and it is now underway, It's going to be a city-based thing. It's going to be led by Auckland, Wellington, Christchurch, and the regions. It's not as if they're going to be, horrible. It's not going to be ugly, but they are going to lag in this cycle. And this weakness, because of the slowdown in China, is going to be one of the factors which contributes to this. So all the best out there, and hope you have a good week. Cheers.